Good morning, everyone. Warm welcome to each one of you joining from different parts of the world. On January 1st, 2026, we launched a CA Speakers Forum, and today is the 10th session of that forum. And your participation, active participation, has made it a successful initiative. A deep gratitude to our esteemed speaker, CA Nishit Parikh, who is here today for this milestone session, I would say, 10th session in many sessions to come ahead. And as we celebrate this 10th session today, we are up here again with a topic which connects to taxation. Taxation is a key in this evolving environment in UAE and entire GCC. Because if we look at the history of any GCC country, there have been certain introduction or changes happening at this given point of time. When it comes to taxation, for people from us who may come from India or other Indian subcontinent countries, the taxation is not very new to us. We have studied taxation maybe from our school time, and we continue studying it. If we look at the history of UAE, it was more than 50 years ago that I see that customs duty was levied here in UAE. And then in 2003, unified GCC customs code was introduced. When it comes to the significant changes, when if we look into the UAE, when taxation was introduced, that was the year 2017, when we were looking to get the VAT introduced into the country. And it was August 2017 when a draft law was introduced, and I was very actively involved in the initiatives of ICI, because at that point of time I was a regional director of ICI for Middle East. And at that point of time, within a few days, the ICI published its publication, and in October beginning, the hard copy of it was made available in UAE. That was a period when ICI had came with many initiatives, and I was handling more than 10 initiatives on taxation, which we had taken up for VAT. Then the journey has been evolving with corporate law, the other international taxation regulations, and this journey continues. It's evolving, it changes every single day. But there's one topic, the free zone taxation, which is of significant interest. And why it is of significant interest to members, to the finance professionals, to the business community here in UAE, because UAE has around 50 plus free zones in the country. And that makes it interesting. And each free zone may not be same, right? Some may be designated, some may be non-designated. So when it comes to taxation, there are multiple forms of taxation. There are multiple categories of free zone, and the businesses will vary from business to business when it comes to production, goods, services. So there's a lot for us to understand well and to see that we are compliant. And keeping that in mind, we have someone today who is an expert in the subject, and he's Nishit Parikh, who is a director with one of the leading firms. You can see the name on the screen here in UAE, and he is a chartered accountant and qualified professional with experience of close to 2 decades. And he leads the practice for the firm in UAE, and He will be here with us today for 1 hour to see that we understand the subject better. In a better way, we understand. And before I hand over to Nishit, I request you now to please show your love with emojis to welcome Nishit with a big, big round of applause. Thank you all. Show your love. Thank you. And Nishit, before I hand over to you, what would your first words would be in this webinar today? Yes.
Thank you, Prabdeep ji, for such a kind introduction. And first of all, many thanks to Prabdeep ji for creating such a nice forum where all CA fellow members or all practitioners of corporate tax, transfer pricing, indirect taxes get together on a Saturday and try to share thoughts. And thank you, Prabdeep ji, for
Thank,
inviting me to this webinar. The objective today would be to take through some of the regulations of free zone taxation and
right.
try to put some practical experience which I have undergone in the filing season which we went through, and what are the
Mhm.
typical challenges we've faced. And I would
Mhm.
encourage the audience also to put out after the webinar any issues which they have faced which I have not covered in my presentation, but they would have faced, and either we can discuss on the webinar or they can reach out to me and would be happy to learn more about the same. Thank you.
Thank
Thank you
you.
so much for
Thank
doing
you.
this.
Thank you. Thank you, Nishant. The screen is yours. Thank you. I request once again the audience to please hold on to your thoughts and questions towards the end as the chat disturbs in between. But when Nishit asks you for any questions to be answered, you are free to use the chat. Thank you.
So let me know if my screen is visible, then I can start the presentation.
Yes, Nishit, go ahead, please. Thank you.
Okay. Good morning, everyone. So I have around 50-55 minutes to talk to you. So I'll try to spend more time on areas which I feel deserve more attention. And as a part of my overall presentation, I have to cover from the basic to the advanced level. So I've done that. But on the basic, probably I'll not spend too much time. What we are going to cover today is overview on corporate tax, how the corporate tax is, what is the coverage, what are the rates, then getting into what are the conditions for claiming a free zone tax benefit, then talking about certain specific qualifying activities and some of the important points which we have observed in those qualifying activities, then touching upon the domestic permanent establishment, and time permitting I have a couple of case studies which I will take you through. So before even starting, one very important question I'm sure everybody here would have in some form or the other done something we called as impact assessment or filed a return for a qualifying free zone person. Uh, can with a yes or no tell me that uh, how complicated or how in detail were you able to check substance related provision for a free zone entity? If you were able to satisfy your own self regarding the substance of your client, please say yes. If not, say no or say not sure, because that is one of the important areas which I see. The clients come at the last time and then you end up doing a check, but some of the details are not available, not satisfactory, but the due date is on your head, so you have to file the return. So now coming to, as Prabdeep ji mentioned, corporate tax is an important topic. Corporate tax got introduced for financial year beginning on or after 1st June 2023. Obviously, unlike the previous draft law where they said that free zone entity doing business with mainland would not qualify and everything else would be qualifying. When the final law came, there were substantial changes. So free zone entities were not given a free pass. They were asked to satisfy various conditions in order to claim 0% corporate tax benefit. Till today, even after couple of years into the corporate tax, I get calls from the client saying that I'm in the free zone, why I'm required to pay tax. So that's the kind of information available with some of the smaller clients. So it is our role to educate them that no, it is not just being in the free zone, you will be able to claim the free zone benefit. There is much more to it. Now, coming from a coverage, corporate tax is applicable to everybody, be it companies, firms, LLPs, JVs, foundations, all of it is covered under corporate tax as a resident taxpayer. For natural person, obviously, they have a criteria that anything other than business income would not be taxed, like your investment income, wages income, etc. And business activities also would be taxed once the turnover crosses 1 million dirhams. However, for non-resident, there are specific instances where they would be charged to tax, and specific instances include having a permanent establishment in the UAE, or a foreign company having a place of effective management in UAE, or any foreign juridical person having a nexus in the UAE. So these are the cases. And also, yes, an individual who is sitting outside of the UAE can also have a permanent establishment in the UAE. So in those cases also, you need to examine whether he is having a permanent establishment and whether he is crossing 1 million dirham criteria or not of the turnover. Now, coming to tax rates, everybody is broadly aware that from a tax perspective, for qualifying income, it is 0% tax. There are certain specified income for a free zone entity which may not be qualifying activity, but then they will get directly taxed at 9%, like income from non-qualifying IP or income from real estate, so on and so forth. And for mainland, there is a exemption up to 375,000 dirham, no tax. Anything in excess of profits about 375,000 dirhams, you pay 9% tax. Obviously, while I talk about 9% tax, from 2025 onwards, we have a new law introduced under UAE, which is Pillar 2. So the corporate tax rate in the UAE for large groups, either companies which are part of a large group in the UAE, or are the holding company or the parent company of a large group, and the consolidated global turnover of those entity as a group crosses 3.15 billion dirhams, then pillar 2 provisions are applicable to that entities, and the effective tax rate by adding the top up tax, that is the domestic minimum tax, could go up to 15%. These provisions are already enabled under the law. Technically, first year for this law has already passed if you are following a calendar year or April to March year. And still we are awaiting details on how to register for Pillar 2. And one form on Pillar 2 return has been published, while other form we are still awaiting. Obviously, for smaller entities which are part of the larger groups, there are certain safe harbors available which you need to examine to see whether they move out of the Pillar 2 provisions or not. Now, coming to qualifying free zone person, what are the conditions? One is maintaining adequate substance, and this substance requirement categorically mentions that you need to have an adequate substance in the free zone or in the designated zone. So again, it is not that you need to have substance in the UAE, but in the free zone. Now, one interesting question which comes along from my clients is that, say, I have an office in DMCC, but can I operate from DIFC? Both are free zone, and you are saying maintaining substance in free zone. So while we check the law, there is no specific ask of maintaining substance in the particular free zone from where you are operating. So potentially it is possible to take a position that till the time you have a substance in a particular free zone or in any free zone, then you should be eligible to meet the substance requirement. Second, obviously, obvious condition that if you're claiming benefit, you should not go yourself and select that I don't want to claim the benefit or I want to go for the normal tax regime. Third, complying with arm's length principle for related party transaction. I don't know, but if you guys have observed or not, if you read the regulations very, very carefully, the compliance in Article 18 for free zone, it only talks about meeting arm's length principle for related party transaction, and it does not cover connected person. So the inference can be drawn that if the connected party payments are not at market value, your free zone benefits are not impacted. You can make a suo motu adjustment and continue claiming your free zone benefits. If you read it, they don't talk about transfer pricing in general. They provide the specific articles of the law, and Article 3455 they cover in the law, and they don't cover 36, which covers the connected person provisions. So technically, connected person is out. I don't know Whether everybody knew this, or if this is a new discovery, please say yes. I would be happy to know that. And fourth and most important condition is deriving qualifying income. Obviously, there is a list which we will go through of qualifying income which you need to be doing in order to claim this benefit. And they had in the initial circular mentioned that meet any other condition which is prescribed by the authorities. So, two additional conditions have been prescribed. One is on de minimis. They say that, okay, we understand that as a part of business, you may earn certain income which is not qualifying. Okay, you can do that till the time it is not exceeding 5% of your total revenue or AED 5 million, whichever is lower. So it could be 2% of your revenue, but if it is 6 million, still you will disqualify. So you need to be mindful of this fact. And second and most important, prepare and maintain audited financial statement as may be prescribed. So again, these two are additional condition which you need to do. So if any of the condition you don't meet for that particular year and next 4 years, you lose out on the benefit of the free zone. Again, from the sixth year, you become eligible to re-examine the condition and see whether you qualify or not. Again, when you are calculating the de minimis condition, please be careful that following items which I have mentioned on the right hand side on the lower part, revenue attributable to permanent establishment or non-qualifying income from IP or taxable transaction from immovable property should not form part of your turnover or as well as your non-qualifying income. So this income will directly get taxed at 9%. Balance income will get taxed at 0%, assuming you are meeting the de minimis condition. Now, how to go about finding out what is your qualifying income? So basically, first see who is your person from whom you are receiving income. Are you receiving income from a free zone person? If the answer is yes, then technically it becomes a qualifying income without even looking at any other condition. Only two things you need to check. One, the person who is taking your services or taking your goods should be the beneficial recipient of those goods or services. He should not be a conduit. So we have had a scenario where one of the client having a consulting firm in DIFC, having a, a subsidiary in DMCC. From DMCC, he was engaging with mainland clients, foreign clients, and other free zone clients. And all the activity of that DMCC entity was ultimately outsourced to the DIFC entity, and they did not have any employee virtually in DMCC. So here in this kind of cases, there is a challenge because what you are trying to do or what is happening by design is that major part of DMCC income, which in its independent capacity would have got taxed because it is dealing with mainland and dealing with a non-free zone person, is getting transferred from a transfer pricing mechanism because major substances in DIFC to the DIFC entity, and DIFC is saying that okay, my income is from DMCC, which is a free zone, so it is exempt. So in those cases, this beneficial test, recipient test, would come into picture, and you may lose out on the benefit for the DIFC entity as well. So it is important. Obviously, you also need to check that your income from free zone person is not covered as a part of any excluded activity. Second, if you are not dealing with a free zone person, then you need to check what services or what activities you are doing, whether it falls under the qualifying activities list or not. If yes, then you need to check whether it is not in the excluded activities, then it becomes a qualifying income. In addition to that, any income which you derive from exploitation of a qualifying intellectual property is also a qualifying income. They have provided a detailed decision on how to compute that, and we will broadly cover that in our presentation. And lastly, all non-qualifying income can become qualifying income if it meets the de minimis test like we discussed. That is, it is below 5% and it does not vitiate the 5 million threshold which has been provided. In addition to that, for immovable property, they have said that if you're having a commercial property within the free zone as a free zone entity and you earn any income from a free zone person, it is exempt. But other than that, it is taxable if you rent it to a non-free zone person, or if it's a residential property that is a non-commercial property, it will be directly taxable at 9%. But under this scenario or this scenario, you will not lose out on your free zone tax benefit. It will directly get taxed at 9%, but it will not be considered as a non-qualifying income. So this is how, if I am a consultant or if I am a senior professional in a company, this is how I would look at while examining whether my income is a qualifying income or not. First and most important point is that whether you are a qualifying free zone person. And for that, you need to check with the free zone authorities that from the free zone which you are operating, whether it's a qualifying free zone or not. Many people, after filing returns, have received a question from the FTA asking for that, are you from a qualifying free zone? Can you give a confirmation from the free zone? So this is an important check which a lot of people had not done at the time of filing the tax return. If answer is no, then straight away it becomes taxable income. If answer is yes, then you look at your sources of income. Is it from free zone person? Then like we discussed, check beneficial recipient test, check whether it is excluded activity or not. And if all the answer is yes, 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 then you take the benefit of 0%. If it is a non-free zone person, including if you are dealing with any overseas person, then you need to check whether the activities you are doing qualifies as a qualifying activity. It should not be an excluded activity. If the answer is yes, yes, then you end up and you go to 0% tax. In any other cases, you generally end up going to a non-qualification, and for 5 years you will not get the benefit. Obviously, for domestic, foreign, PE, real estate, like we discussed, for free zone entities, there will be a direct taxation of 9%, and it will not impact your free zone status. Now, coming to substance, mainly from a law perspective, there are three tests which have been provided to examine substance test. And one of the things which I have seen that a lot of people who have done ESR try to apply the ESR logic while doing a substance analysis for the corporate tax. But the laws are pretty different in terms of certain aspects. So while fundamentals can be applied, but word to word that logic cannot be applied, because here they have given more stringent test to be satisfied in order to have a adequate substance. One is the CIGA test, like the core income generating activity test. That core income generating activity always has to be conducted out of the free zone or the designated zone. So for each business, you need to look at what is a core income generating activity. For a trading entity, purchasing and sales would be the core income generating activity. But for a manufacturing entity, the manufacturing process, the distribution process, the warehousing, logistics also could be the core income generating activity. So for each different activity, and to give you an example, if you are only an entity which is sourcing materials in the UAE for your parent company, then that sourcing may not be the core income generating activity, or the buying and selling activity could be different for different activities. So for each business type, you need to examine what is your core income generating activity, and you need to see whether it is being performed from the free zone or from the designated zone. So designated zone, there is no leeway, like I mentioned earlier, that if I am working from DIFC for a DMCC entity, it is okay. But if you are claiming distribution business benefit, then designated zone is compulsory. You may be working from a different designated zone, that is okay, but then you need to be in a designated zone. Second is the asset test. So your assets should be adequate depending on the business you are conducting. For a manufacturing entity, you should have relevant machineries, IPs, etc., in order to do the manufacturing. Whereas for a consulting business, it could be laptops, etc., which would be a very small asset base. Whereas for a high intensive business, the asset base could be significantly higher. Again, you should have adequate operating expenses and adequately qualified employee to perform the job. So you can't be having a 200 million turnover and one person who is not adequately qualified managing that business. Then justifying your substance would become a problem. Obviously, what is adequate number of employees, that has not been defined, but you need to look at the business on a fact to fact basis, and then you need to analyze. Again, any non-core business activities can be outsourced. Core business activities can be outsourced, but within the free zone or within the designated zone. But you need to ensure that you are maintaining adequate supervision and control on the same. Now, the free zone guide clearly says that substance needs to be maintained throughout the tax period. So we saw that recently in February, March, a lot of people went out of the country because of various reasons. So in those cases, the substance may also have moved out with them. So how this will impact, whether there would be any relaxation, is something to be seen. But this is something you should start talking about, seeing with your clients that how during this period you are maintaining your substance within the free zone or designated zone. Again, Non-core activities can be outsourced even outside the free zone, outside the country, no problem. Bookkeeping, accounting, taxation, or whatever would be your non-core business activity can be outsourced. What is core activity is the income which results in revenue. Sorry, the activity which results in revenue would be your core activity. Again, adequate substance has to be commensurate with the business. For a 1 million business, one employee, okay, may be satisfied. But for 100 million having one employee, then it is very difficult to satisfy, right? So you need to be mindful of that fact. Second, don't use employees interchangeably, right? You have a headquarter in the free zone, you have a branch in mainland, your people are on branch license, and you are saying they are working for the free zone entity also, so I'm meeting the substance. So then it is up to you to prove how they are working for the free zone, why their insurance or their license or their visa are with the branch entity, whether there is an agreement, any written document to say that while the license, visa, etc. is here, but they have been deputed, outsourced to this entity, whether you would be able to prove that they were coming here and working. So all of this is important, and you need to be mindful of the fact. Now there are certain examples which very quickly I will go through. For fund management services, even if you have people here, but your core investment decisions are taken by an investment committee which is sitting in your parent company's jurisdiction, then you will not meet the substance test as per the guide. For headquarter services, yes, given that headquarter services is there, you need to provide strategic guidance and management. Then you may require to visit the offices of your subsidiaries, regional companies, etc. So they allow you to visit those entities, and you need not be fixated to your free zone. So you may have to visit those companies, and in these cases substance can be made. For holding company, they have categorically mentioned that yes, it's okay to not have employees, but you need to demonstrate that the board of directors have taken decisions, investment disinvestment decisions within the UAE or within the free zone. uh, Obviously, a lot of before this guide came, a lot of people were thinking, okay, I have a subsidiary in DMCC, I'm doing trading business. Let me hire a warehouse in designated zone and I will be able to meet the distribution condition. Now they have said that just having a warehouse for distribution, but all other core income generating activity like sales, etc., happening from your office, which is not in a designated zone, will not meet the condition and you may not satisfy this. On the alternative, they also said that if the core income generating is in the designated zone, but you have majority of the people working outside of your designated zone for non-core activities. So in this example, 20 employees in designated zone doing core business activity, 480 people outside doing non-core activities of delivery, etc. Still, you will meet the substance. In the above case, even if you have a warehouse in the free zone, but core income generating activity happening from other free zone or from mainland, etc., then you will not meet the free zone. Again, last case study is on outsourcing of core income generating activity. Then the onus is on you to prove that you had adequate mechanism, the agreements provide for proper review, etc., of the outsourced partner. So this is the list of activities which are considered as qualifying activities. Couple of important aspects which got changed in 2025, while just before filing the return, they came out with a revised decision 229, which changed the meaning of qualifying commodities. Obviously, it was a beneficial circular because it liberalized the provision. Earlier, there was a condition that the commodities you are trading should be traded in the raw form, but now they said that we are covering even the commodity as well as the associated products, and also the listing, the commodity being listed in a stock exchange was there, but they also added that even if the prices are quoted in a price list by a recognized agency which they have prescribed, still you will be meet the definition. So while this was helpful for many, but some of the client faced an issue who had filed a return for 2024 for that 6 months, 7 months period, where because of this provision not being there, they have not claimed the benefit. So for them, filing a VD, taking a claim, whether that is possible, not possible, were the questions, because generally voluntary disclosure is to correct errors. So whether this can be considered as an error and whether I can do that or not is something which was a question which came about. Second, treasury and financing services to related party also had a lot of issue, whether I can invest on my own account, whether I can do anything else, things like that. But now they have added the word specifically for its own account, and this is what has been happening. One of the important aspect for manufacturing companies which are not in designated zone we faced was the guide says that for a manufacturing activity, distribution and sales activity is covered as a qualifying activity. It is only if it is ancillary. If it is not ancillary, then it should be carried out from a designated zone. So this, if I have to interpret it very closely, it means that if I'm a contract manufacturer, or if I'm somebody who has a fixed contract, or where the customers are approaching me, I'm not approaching them, then it may be ancillary and I can do that. But where I'm doing active sales marketing as a manufacturing entity, then potentially I may not get the benefit because I need to do those activities from a designated zone. So question is that whether can I create a branch in a designated zone, put the salespeople there and continue the benefit. So these are the kind of structuring which we have done for few of our clients, and hence I'm talking about this. Processing of goods or materials. While the definition is very wide, one interesting issue came that by only doing labeling in the UAE, can I get the benefit of processing of goods or materials? Because if you look at the definition, it is very wide. It talks about physical changes if activities like even assembly, repackaging, etc. is covered. However, labeling is just an ancillary activity. Whether in itself can be covered or not is a question. My personal view is it may not get covered, and happy to hear any other thoughts if people have. Uh, Now, from a shares and security perspective, cryptocurrency was one of the question whether it is covered or not. So the guide came out. It specifically said that cryptocurrency is covered. Obviously, 12-month holding period is required, and all debt instrument which are convertible are covered, but pure play debt instrument which has optional convertibility, whether those are covered or not was a question. Because while if it's are surely convertible, then yes, it is covered. But if it is optionally convertible, then there was a challenge because you don't know whether this option would be exercised or not. So there was a risk of claiming the benefit if it's optionally convertible. Now, like I mentioned, right, that for these activities, they said that substance can be met if there are no employees, but you need to designate or prove that all the investment and disinvestment decisions are taken out of a free zone by the directors. So what happens in all cases? I have a company from 2018 and I am holding three investments from 2018. And at that point in time, since corporate tax was not there, ESR was not there, I took all the decisions sitting in my home country, and it was business as usual for me. So whether this will impact my substance because the decision for investment was not taken in the free zone. So my personal view is that logically you need to look at when the law got implemented. And once the law got implemented in 2023, whether post that, if there are any significant decisions related to the investment, those should have been taken from the free zone. And then ultimately, when you disinvest, that should be taken from the free zone in order to meet the substance test. The old cases should not be denied the benefit merely because it was done earlier when the regulation was not in place. Now, coming to qualifying commodity, while the definition got extended, relief was granted to associated products, hedging, structured commodity financing. One important point which came about in this particular matter, and which is important to discuss, is that whether disqualification, because here if you look at this line, it says that is provided this activity sorry provided this activity is not conducted by a qualifying free zone person whose revenue from distribution, warehousing, logistic or inventory management function constitutes 51% or more of their revenue for the relevant tax period. And now if you read the definition, it says means the physical trading of qualifying commodities, associated financial derivative trading used to hedge against risk involved in such activities, and associated structured finance activity, provided that this activity, here it is in singular, provided this activity. So does this 51% criteria apply only to structured commodity financing activity? That means if I'm doing structured commodity financing, then I will not get the benefit if 50% or more of the revenue is from these distribution activities. Or even if I am trading in qualifying commodities, I need to still satisfy this condition, because a qualifying commodity trader would have a warehouse, would have a logistic as a part of its business. So this is something which is a gray area currently, given that this decision came in 2025 and guide was released in 2023. We've not got a revised guide yet on free zone, and this area remains open. Couple of companies have taken the benefit and also have gone for public clarifications, private clarification for these issues. Again, fund management services is pretty simple, but again, a couple of issues which we deal with our DIFC clients is that they talk about outsourcing of activities to sub-advisor. And if you read the definition in this entirety, it gives an impression that the investment advisor as well as the sub advisor needs to be under the regulatory oversight of a competent authority in the state. However, if you read the guide, it only talks about that the free zone company which is claiming the benefit should be regulated by a competent authority. So does that mean that if the sub advisor is not regulated, still it is okay? But the law, the way the wordings are drafted in 229, it gives a different impression. So conservatively, our view is that even if you are outsourcing to a sub advisor, you need to ensure that he is also regulated by some authority in the UAE or ADGM or DFSA or FSRA. Again, another important question comes is that lot of talent in terms of equities, research, etc., is available in Asian countries. So if I am getting a pure play research activity done outside of the free zone, whether it will meet the substance test or it will tantamount to outsourcing of the core income generating activity. So the question here is that if pure play, I would have bought reports of Bank of America or or an Indian fund, etc., then that is just taking support of somebody to frame a decision. Similarly, if I am having a pure play junior research team in another location like India, Philippines, etc., where I'm just taking data from them and using that data for making a decision, investment decision, then I can say that the uh, substance test is not vitiated. But yes, a lot of decision recommendation is coming from that particular entity, then potentially there could be a gray area, and on a fact to fact basis, we'll have to see whether it breaches the substance test or not. Another important is wealth and investment management services for DIFC, ADGM, and various other free zones. So your typical model in the UAE is that they have this referral fees or retrocession fees agreement. So here what happens that, say for example, Prabdeep comes to me and says that, okay, I want to invest in structured financial products. I say, okay, I can help you. I am the investment advisor. I talk to Citibank, I talk to Leontech Bank, etc., and say that these are the products which is good for you. Please buy them. You will get X returns. And he buys that. So while preliminarily my services is to Prabdeep, which is investment advisory, but my income will not come from Prabdeep. It will come from the financial institution. So whether service provision is investment advisory, but the person from whom I'm receiving revenue is not investment advisory income, but it is referral fees, retrocession fees. So here we worked with a lot of clients in terms of improving their documentation to say that how both are linked, and how we can say that ultimately what I'm earning is for these services, while the nomenclature can be anything. Second issue we face that I am an investment advisor and Prabdeep is also an investment advisor. I have better connect with Citibank. Prabdeep will come to me and say that this product I'm getting at this price. Can you get me at this price? Because of my connection, I can get it at that price and I will pass it on whatever I earn from them, some portion to Prabdeep, whether those transactions are covered or not. Again, this is something depending on agreement to agreement you need to take care of. Lot of companies as a part of their business get requests that, okay, I want insurance also. They refer it to the insurance companies and get a referral fee. Whether this is covered, because insurance technically is not investment advisory. So again, if you read the guide very carefully, it says that if you are managing a portfolio and if you are able to substantiate that as a part of overall portfolio management, I recommended as an investment advisor to the client to take insurance, and as an ancillary activity I was able to get him an insurance, then it may get covered. Pure play, having no investment business with that client, just selling him insurance may put you in the wrong side of the law and you may not get the benefit. Now treasury and financing services for related parties on its own account. How broad can it get? Can I start doing active trading as a treasury function, or it is just to park temporary funds in a secured bonds, FD, etc.? Or I can start a full-fledged treasury function, give loans, do structured products, etc., etc. is a question which a lot of corporates are evaluating. Again, what we have seen that in many cases the entity is a trading entity, which is qualifying activity, but over a period of time, the trading business is 1 million and the business on the treasury side is 10 million. Whether I can still claim that benefit if my core income of trading as per license is only 1 million, but my investment income is 10 million. From a tax perspective, I believe it you can, but obviously free zone regulation, allowability of this activity, etc., needs to be checked. Now coming to headquarter services, again, if you look at the definition very carefully, and there was one important aspect which now probably a lot of people are not talking about because people are taking a conservative view. If you read this, it says managing of business activities of related parties, including the provision of senior and general management captive, blah, 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 and providing other support services to related party. So whether this other support services party has to be read with all of this put together, or even providing a support service activity can qualify as headquarter services. Obviously, if you read the guide, they talk about having senior management in the UAE, having strategic guidance, and then providing other activities. So the view is that no, the conservative or the better view is that you need to be providing a holistic services and not only the support services. Second, can a subsidiary company provide headquarter services to a holding company or a group company? According to me, while headquarter is the word, still need to look at the services. So even if a subsidiary company is providing services to headquarter services, you may still be able to claim the headquarter services benefit. Again, on distribution of goods or materials, two key aspects to be taken care of is that one, end user. We've seen during filing returns, none of the clients or majority of the clients had not taken any declaration from the customers that they are not going to use this for personal purposes, they are going to resell this. So one of the condition to claim distribution of goods benefit is that the goods you are selling it to should be a person who processes or alters such goods or materials for the purpose of sale or resale. So he cannot be consuming for its own use. So for example, if I am a seller of oil and somebody is buying oil for me for maintenance of his machinery, then it is not qualifying activity under this particular activity because he is using for his internal consumption. Or second is many a times, if you are selling it to a public benefit entity for their own consumption, then this exception of end user test does not apply to you. So just to summarize this very quickly, whenever you are examining distribution activity case, only in cases where you are importing goods from outside of the UAE, those goods need to pass from a designated zone. In all other cases, goods, even if don't pass within the designated zone, you will still be eligible to benefit. So in example one, build to ship to, where you buy from country A, sell it to country B. Obviously, goods will not come to the UAE. Still, you will be able to claim the distribution activities benefit subject to meeting substance and other tests. In example two, while you are importing into UAE, then you need to import into designated zone and then give it to the mainland buyer. Then only you will get the benefit. In example three, you will purchase from UAE mainland and sell it to a country A which is outside UAE. Here also from the mainland's location, it can directly go to country A. It need not pass through the designated zone. Again, the third case, you are buying from mainland and selling it to mainland. Still, the goods are not required to pass through the designated zone. This is the same. These are the regulated activities, excluded activities. Obviously, one important aspect here is that even ancillary activities which you are providing would also get covered in the excluded activity. So one important aspect here was that if you deal with a natural person subject to certain other activities, that is not that is considered as an excluded activities. Question is that what happens if you are dealing with a sole proprietorship? In UAE, sole proprietorship can have a company, but in other jurisdiction, there is a possibility that sole proprietor is operating more like an individual business. So can I say it is service given to a individual, or can I say that it's a service given to a business, and hence I should be eligible to claim the free zone benefit and it may not fall under the excluded activity. Another aspect is qualifying income from qualifying intellectual property. They have defined qualifying intellectual property as patent, copyright, or any other similar rights. Again, two important condition is that patent is registered under any of the law. So we had a case where client had built a software and they had not registered it, neither capitalized it. So whether in those cases, what do? Even if you go for a registration, you will not have any asset in the balance sheet, then still will you be able to claim the benefit or not? Potentially, you may still go ahead and claim, but you will have to prove that what are the kind of expenditure you have incurred, whether the capitalization which was not done was aligned with IFRS and things like that, you will have to take care of. Again, they have given a formula how to do calculate a qualifying income from a QIP. It is qualifying expenditure plus uplift expenditure upon overall expenditure into overall income. So that portion, whatever comes, will become your qualifying income, and balance will become non-qualifying, in not non-qualifying, but income which is directly taxed at 9%. Here, one of the important parts is that you can outsource the research activities. However, you cannot outsource it to a person outside the UAE that is a related party. So you can outsource outside UAE to a non-related party, but not to a related party. Now coming very quickly to domestic permanent establishment. Uh, why this is important? Because any activity you do through a domestic permanent establishment, that activity will typically be taxed directly at 9%. So again, two types of PE which are defined under the law, similar to OECD. One is a fixed place PE, having a branch office in UAE, warehouse in UAE mainland, office employees working from UAE, or events in UAE could potentially cause having a fixed place permanent establishment in the UAE. So your potential issues which we were discussing with our client was that uh, they were having a lot of consultants who were working remotely from a lot of other locations, and they were doing a lot of core income generating activities. Question was that whether they constitute the permanent establishment outside of the free zone, and whether whatever income is attributable to their activities should be identified by transfer pricing and should be taxed at 9%. Many companies in the free zone have policy of work from home. Whether somebody working continuously from home or from remote offices in mainland because the location is not convenient to travel every day, whether those two also can become your fixed place PE outside of your free zone, and whether if those activities which the people are doing constitutes core income generating or activity which contributes to the revenue, whether that also needs to get taxed at 9%. Because these are the issues, when you go deeper, you'll realize that this have not been examined, and potentially you will have to check this more in detail. Second is agency PE. If you are acting as an agent for any business and have authority to conclude contracts, then you can become a agency PE, a domestic agency PE for your business. This sometimes looks funny, because for signing contract SLA, etc., employees will go out of the free zone and will get those contracts signed. But then the question is whether an employee can be considered as agent or not. So there the potential view is that employee should not be considered an agent, and hence agent CPE should not trigger. However, if you are doing it for your through your agents, directors, etc., then you need to examine this aspect as well. Now coming to compliance requirements for a free zone entity. Yes, they need to maintain audited financial statement. They need to ensure they have transfer pricing documentation in place if they are meeting the thresholds of 4 million and 40 million and 500,000 for the KMPs. Free zone condition evaluation should be on a year-on-year basis. We've seen businesses changing, we've seen employee count changing. So it is important that free zone should not be a one-time exercise in 5 years, but every year you need to evaluate and then file the tax and transfer pricing returns. Obviously, you need to be mindful that tax groups cannot be formed for a free zone entity. Transfer of tax losses, etc., benefits are not available to free zone. SBR is not available to a free zone entity if you are claiming benefit. And we've seen a lot of issues in IFRS. Write back of loan, it becomes an income. So, what are the alternative options under IFRS? Whether it can be classified as equity and so on and so forth. So, IFRS knowledge as a tax professional also becomes important for us to apply and help our clients in terms of filing their tax returns. We have 2-3 minutes, right, to take two case studies.
Yes, Nishit, we can take, you can take the case studies, and if required, we can extend by 10 minutes. Yeah.
Sure.
Okay.
So, one interesting issue which we faced for our clients who are into gold bullion trading. They had 100 million, for example, revenue from gold trading, and they also had a derivative trading in shares, currencies, etc., which resulted in a 10 million dirham loss. So, from a de minimis perspective, items identified in A is qualifying income because it is physical gold trading, which is covered under qualifying income. Whereas derivative trading, if it is not for hedging, it is not considered as a qualifying income, it becomes a non-qualifying income. So the question was that how do I compute de minimis? Whether I have to take this negative income as 110 and then apply 10, or I have to ignore this minus 10. So our view is that if you read IFRS, they talk about revenue is something where you have an inflow. In cases of negative inflow, it cannot be considered as a revenue. So here you would most likely consider 100 as your total revenue, and your benchmark to compare would be minus 10 or 0, which is less than 5. So you should have a qualifying income. Happy to hear if somebody has an alternative view, because I understand that in the industry people do have alternative views on this as well. Now, this is the most interesting, and I would be very, very happy to hear views on this, because I have different views than most of my colleagues, and I end up having a long discussion with them on this topic. So, the law says that transfer pricing compliance, or you need to meet the arm's length principle if you want to claim a free zone benefit. Now, if you look at two scenarios, one scenario is that my arm's length range is coming to 105 to 110, and revenue received from related parties 100. Now the question is that if I do a suo moto adjustment in my tax return, whether I can say I meet the arm's length range and hence free zone tax benefit should be available to me. My personal view is that you should not get the benefit, because technically in your books you are not creating a receivable by doing a suo moto adjustment in the books, or even by adjusting the pricing with your customer. So technically, you are not meeting the arm's length range at the end of the financial year, but you are doing an adjustment in the return. However, some of the views in the industry is that given that I am adding it for my tax calculation, there is no loss to the revenue and you should get the benefit. My counter argument there is that if you are itself not claiming a free, if you yourself are claiming a free zone benefit, you are actually not paying any taxes. So making adjustment of 100 or thousands of crores will not make any difference to you in the return. The logical reading of this should be that whatever is due to UAE should receive, and hence you need to make the adjustment in the books, and hence your party which is there should be paying it to you. Similarly, on the opposite side, what happens if I am earning more than the range? Because it says you need to be within the arm's length range. Here again, the problem is that the guide, etc., says that the remuneration should be within arm's length range and should be based on the functions performed by the UAE entity. So if your function performed or the assets or risk you are taking only gives you a remuneration range of 105 to 110, whether 120 also meets the test or not is something I'm pretty doubtful. Again, obviously there are two views in the industry, but I thought I wanted to bring it out in open and see if anybody has a different view, and if somebody has a more logical argument, then I can also get convinced. So with this, I would like to end my presentation. Thank you everyone for your patient listening, and I hope this session brought about some new aspects and it was helpful to you guys. Thank you so much.
Thank you. Thank you so much, Nishit, for your wonderful session. Deep gratitude for taking out time on Saturday morning. And we can take the questions now. Anyone who is looking to ask a question, can you please use
Mhm.
this hand for raise your hand, and I will then ask you to unmute yourself. Yeah. So, who is there? Please raise your hand for the questions, and we are good to go. Yeah, yeah. So, Nishit, we have first question. Let me allow Ramakrishna to unmute. Rama, can you please unmute yourself?
Yeah.
Yeah, please go
Thank you so
ahead.
much, sir. Thank you,
Yeah,
Nishit, sir. It was a very wonderful session.
please.
Yeah. I
10
have
minutes.
one.
बस हो
Hello.
गया हो गया already.
I have
Sorry.
one query with respect.
Yes, Rama, I can hear
Hello.
you. Go ahead.
Yeah. Yeah. So one of our client has actually is operating from free zone. However, there was no substance condition met. And in the first year, since the company is into profit, so that's why I mean, for, well under the 3 million threshold. So that's why they have, in previous year they opted for SBR. Now in this particular financial year, they have met the substance requirements from in the UAE. And now, how to go about this situation, sir?
So see, effectively, the moment you claim SBR, you yourself are opting for being governed by regular provisions of the city law. So that itself disqualifies you for that year as well as the plus 4 years. So unfortunately, for this 5 years, you may not be able to claim the benefit because you have vitiated the condition uh, for claiming the benefit.
Where's Rama? I don't see him. Rama, is it fine? Anything else you would like to ask? Okay. Not sure. Where's Aj? We'll go ahead with the next question. Sorry for the inconvenience, these disturbances a few minutes back. Ajay, can you unmute yourself?
Hello, sir. Thank you.
Yeah.
Thank you very
Thank you.
much.
Yeah.
Thank you for unmuting me. And thank you very much, Sir Nishant, sir, for the wonderful session. So my question is related to corporate tax filing itself. So basically, I work in a DMCC entity as a senior accountant. So prior year, we had reported corporate tax. Prior year, we were not, at that moment of time, they were not aware of the corporate tax, this claiming of free tax qualifying income. But they prior year, they had claimed corporate tax and they paid the full 9% 9% corporate tax on the profit which they had generated. And so from this year until this year also we'll be claiming corporate tax, but we are planning for implementing the qualifying free zone income right from this year. Just wanted to clarify, can we switch it back now, or do we have to wait for some certain period of years, like because we have not claimed SBR yet, but
So
do
Ajay,
we
is it in
do still have to
qualifying
wait?
commodities business?
No, no, no. It is in ship. it is in marine business, so it's in logistic. It comes in
So
shipping.
then technically when you file your second year return, you will not get
Mm-hmm.
an option only to select free zone benefit. They will lock the option for 5 years.
Okay.
We have seen
Okay.
that.
So until 5 years we can't claim, is it?
Yes. So that year plus 4 years.
Okay. Oh, is it? Okay. Okay. Cool. Thanks. Thanks for that.
Yeah, Amit, thank you, Ajay. Amit, can you please unmute yourself? Yeah,
Yeah,
Amit,
thank
please
you,
go ahead.
Prabhdeep ji and Nishit ji for the insightful session. I was having one query relating to connected person. So normally, like we are taking whoever is a person whoever is listed on a trade license as a connected person. But is there any clarity from the FTA side, like who should be covered for benchmarking for connected person, like whether it would be all CXOs or only people who are listed on a trade license? Like, what is your view on that?
So our view is that a person who is listed as a manager on the license plus all the CXOs and the owners and relatives of these people would be covered under the connected person, because if you look at the definition, it talks about an officer of the company in the connected person, and typically a CFO, director, etc. are considered as an officer of the company. While I understand the sentiment that directors, etc., including myself, are people who are generally professionally employed and not related to the promoter or owner group. But unfortunately, the wordings of the law are such that we have to comply with those guys also.
Okay, thank you. There's a request, Nishit, to take some questions from chat box, but let me unmute Harshil, who has raised his hand first. Yeah. Harshil, can you please unmute yourself? Yeah, Harshil,
Yes, sir.
please.
Thank you very much. Thanks for insightful session by Nishit sir. My question regarding the corporate tax. So currently we have all the group entities in UAE and one entity is in the free zone area, and all the entities are in one tax group. So we are not getting the benefit for this 0% QFZP, although we are generating income from the free zone customer. So if we set up one new free zone entity outside the tax group to getting such kind of benefit, so is it feasible to do these things?
So two
We are in
things
a
here.
manpower supply solutions.
So two things here. One is tax group from a VAT perspective as well as from a corporate tax perspective are different. Corporate tax had requirement of having a separate tax group registration. So when you formed a tax group and you yourself, or means a company itself, included the free zone entity in the
In
tax
the
group,
same tax group,
at that
yes.
point in time only you should have not included that entity. But since you have included, that means you yourself decided to give up the tax benefit. That
Correct.
is first. Second, the moment you set up a new entity, uh, you need to make sure that you look at the GAR provisions. Whether if you are only doing it to save taxes, then GAR provisions come into picture. You need to have a commercial reason and you need to structure your transaction in such a manner that you don't get stuck in the GAR provisions. And once you do that, you don't include that entity in the group and you can claim the benefit.
Okay. Thank you very much.
Uh, yeah, Nishit, there's one question here with regard to the change of the option for being to elect the qualifying free zone option. And then Naina has asked, and she said that she had written to the FT, and they said that it cannot be done. So she's asking why we cannot change the rate, what should be the remedy ahead. I think many people have this query, like many don't understand. Maybe in general, you can throw a light on this part.
So in general, you
Yeah.
need to be mindful that the law provides that in the first year, if you yourself said you are not qualifying, then for next 4 years, you will not get the benefit. That's simple as that. The FTS, that's why lock the option. Unless you are a case where you could not claim the benefit because the law was not clear, specifically in cases of qualifying commodity where the clarification or the change in the law came in 2025. In those cases, people have gone back even 1 year, file a voluntary declaration, change the return for the first year, and then requested the FTA that we are changing the return for first year. So you allow me to change for first year, then automatically in second year onwards also you'll get the option. But in normal case, like one person had asked the question that first year I did not meet the substance, so I took out of the benefit. Now I meet, so they don't want you to do it on a year-on-year basis. They have given you a window of 5 years. So only way to do it is every 5 years, or you set up a separate entity, do the business, but there you need to be mindful of the GAR provisions.
Right. Thank you. Rama, I'm asking you to unmute yourself because it's not easy to read out from the chat. So if you can unmute and say yourself, it would be better. Request others also to follow this. Yeah,
Yeah.
Rama, please.
Thank you, sir. Thank you. Uh, Sir, my question is, in one of the QFZP entities, there is a debit balance in the shareholder's current account. Basically, basically it is withdrawals from the company. So now, after to comply with the arm's length provision, if at all if we charge the interest to that particular shareholder, it is exceeding the I mean the de minimis requirements are not met. So in this situation, is there any chance that QFZP benefits will be lost? Because only for
No,
complying ALP provision.
shareholder loans are specifically covered in treasury and financing function to related parties. So your interest income is a qualifying income.
Okay, okay, sir. Thank you so much.
Yes, so anyone who wishes to ask a question can please raise your hand. Uh, Other thing, Nishit, there has been some requests for presentations. Can we share with them? Is it possible?
Yeah, we'll share it.
Okay, so because we will not know who attended, if you would like to make
I'll
any
just put
change.
out my email ID and my
Yeah,
LinkedIn.
yeah, yeah.
If people can reach out, I can then
Yeah,
probably
yeah.
share whatever
So
I.
here you can connect to Nishit, those who wish to have a presentation and take that. Uh, right. So I'll ask Bijay to please unmute. Bijay, please unmute yourself. Yeah, please go
Hi,
ahead.
hi. Good afternoon, Nishit. It was a very nice presentation and lot of knowledge delivered. I have only one question which I have seen practically. The definition of connected person, it will only fall under the consideration of FTA when the person has the authority to act on behalf of a company by either by way of POA or by mentioning the trade license. Is it correct? Because maybe I have directors, I have CFOs, they are there, but they don't have the authority to act on behalf of company. Though then they will not come under CP, correct?
No, definition does not talk about POA sector, right? It talks about officer of the company.
Correct. But the officer of the company hasn't got any authority to do on behalf of the company. Merely being a director or CFO doesn't mean that he has to be connected person.
No, so my thought process there is that the moment you give somebody a designation and you say that they don't have any authority itself is a anomaly, right? In
No,
a
there could be because
your maybe a
I'll tell you.
specific,
I'll
sorry,
tell
go
you a
ahead.
structure. I'll tell you
Yeah.
a structure. There could be a structure where I have reporting to various different jurisdiction. Maybe I'm reporting to London, or maybe I'm reporting to Europe somewhere, or Switzerland. Okay, and I'm just acting as a local CFO or regional CFO like that.
So simple for change the designation to finance
No,
controller.
no, but why I
The
have to change
moment,
my
see,
designation?
no, I'm saying the moment you give a designation, you need to align it with the definition, whether it is getting covered in the definition or not. In
No,
general,
but the whole moot point is about your arm length pricing. If my CFO having the arm length pricing, then I don't think so. It should be a concern for FTA or anyone else even for the entity itself. I mean,
no, meeting arm's length price, right? You are saying they are meeting the arm's length price, right?
yeah, yeah.
So then there is no problem, no? Then there is no problem. Currently,
So, so the
we are.
definition you said that the director or the CFO has to be connected person. So I'm just talking to the same point. Will there be a connected person just by sake of designation, or it has to be a particular document which will establish that?
I'll just for your benefit read out the definition, so it will make it amply clear. For the purpose of this decree law, a person shall be considered as a connected person of a taxable person if that person is a owner of the taxable person or director or officer of the taxable person. So director is categorically covered. Now, if you say I am a director but still I am not covered, then it's a difficult proposition to digest, right?
Well, I
Definition
had a
is given under
clarification.
the law itself.
I had a clarification on this FTA actually, and I asked this question. They said that if you're not having the POA or anywhere mentioned in trade license that you can act on behalf of entity, you are not a connected person.
But this is
I
not
just want to,
understood your point. But this is if
I
you
had a
read the
practical scenario. I wanted to clarify with you that as well.
understand. So even if you read the guide or the law, this point which you are saying is not coming out. Probably you've got a specific answer from FTA, then it's a different thing.
Mm. So it's a matter of interpretation, you mean to say?
Yes.
Okay, got it. Thank you.
Thank you, everyone. Nishit, before we close for the day, I express my gratitude to each one of you, to you specifically for this session. And what would be your last words today based on your experience or whatever you wish to share? Yeah.
No, thank you, Prabhdeep, for first of all for inviting me, and it's always pleasure to share with our community. And I would definitely look forward to come back on the forum with some different topic where I can add value.
Thank
Thank you
you.
once again for making this forum and inviting me for delivering this session.
Thank you. Thank you so much. Thank you, Nishit. Deep gratitude to Nishit. Please show your love with emojis for this session. And before we close for the day, the next week we will be back with the transfer pricing at same time, Saturday, 11 a.m. transfer pricing session, and look forward to your encouraging participation. Have a wonderful Saturday ahead, wonderful weekend. Thank you, Nisha. Thank you for being here. You do have a great day.
Thank
Take
you.
care.
Thank you. Thank you
Bye
so
bye.
much. Bye.